today I wanted to share with you this important idea of like dealing with money and connect it to the sort of like how to pick uh, good stocks. Like if you're interested in some of this type of way to do this, and and so in general, what we really have to be careful about is this is called like a penny wise but pound stupid. Means just like you really probably if you want to pick stocks or something like that, right? You're probably really thinking like, okay, I'm very smart about how to use money and things of nature. Okay, and hopefully that's what you are. Otherwise, like you might it's just better the invest in the index fund or uh, things of nature. If you know that you're not really good at managing or you don't want to deal with the difficulty coming out of like, through picking individual stocks. But then generally people who are trying to pick stocks thinks like they're really good at managing money and what's really have to be careful is the a, a lot of times this is a little bit novice things. Maybe it doesn't apply to you. But then let's say if you see a company, the stocks is like trading cheap, like just like let's say $5 a share compared to stock that already trading $100 share, you might think, okay, 5 is great or something like that. Just because it's cheap. So I think the audience here it's probably like this is too obvious, but just saying is a lot of people actually think like this. Okay, then I'll buy the $5 one without really investigating the value of the company. As Warren Buffett said, like it's really important when you invest is like think like an owner of the company. You actually own. What does that really mean here? That's the important thing. The main is like you have to really know everything about the operations. Otherwise, you are not really qualified to really invest in that company. And then the price of the stocks, just because it's cheap, that doesn't really qualify you to be an owner. It doesn't make any sense, right? And another thing, the important thing is just because you're an owner, you have to know everything, every detail thing about the operation or financial condition or any of that things. I mean, the more you know, it's of course better. But then that's why there is like sort of like your even within the company that you're gonna investigating within something that you are especially good at. Okay, let's say if you're good at finding out the depth of the company, and then you can kind of like see if it'll make sense or not, or you're more like so you can actually identify that if the managements are honest or they're not that intelligent, or like you're more like a product person, like you know that this product is excellent and so forth. Obviously, if you know all these, and eventually you want to actually create what I just said was actually all quite essential things when you look at the company, that their debt load, their profitability, their product and services, and also management characters. If you find all these four, right, and generally speaking, if you find all these four to be excellent, generally speaking, no matter what the price says, it's a good investment. And I will tell you why. Even if it's like hyped up, right? If those are solid, and I'm not even talking about this like a PE ratio and stuff like that. This is it could be good. Sometimes it could be a good measurement, but oftentimes it's not. So let's say somebody said, okay, wow, this PE ratio is like high, so I can't buy it. I think this is overpriced. This is quite shallow way to looking at, right? It's all the dials. There's a PE or a debt to enterprise ratio, or there's a lot of factors. But then just because the one is up, that doesn't really mean that this company is doing bad or good. You can't really tell. In the accounting things, you can actually get really, really confusing and complicated. And then, that's the thing. Like when I talk about the management honesty is critical. You can actually hide a lot of things even in the public filing. So you got to be very careful about that. And even that everything's good, maybe the time of the company is not that great. So maybe a year or two you might struggle. Like even if you put some money in, like believing that every product in the management you believe in. But the stock market just keep going down, right? So that's normal. The price does not really reflect on the oftentimes the quality of the company. That's really the key here. So if it goes down, what would you do? Okay, you never sell. The more, if you know the company is doing great, if the price is low, only sensible thing you can do is to buy more, right? Somebody is giving you something cheap, so you accumulate. Whether you can do this, and you are watching this company for periods of time because you are the owner. Okay, so you know this price is really low. Buy more. That's and then maybe a year or two further down the road, the company will go up when other people realize that what they couldn't see, finally they've seen in years or two later, and it happens all the time. Because the most of people don't research, and most of people don't have this criteria. They get really distracted by the charting or all this ratio, and they get really distracted. So they don't really check those fundamental qualities of the companies. So make sure that and if the company is really bad, right? Company is not that good. Okay, there's a lot of those. So be careful. Just because it's up on the market doesn't mean it's good. A lot of companies go bankrupt. So, one time the share was like, let's say 100, and it went down to 50, and then you think it's great. Oh, this is the name brand, whatever. If that's all you can see, then you're not the owner. A lot of people do this. Oh, this is a famous company, and it's already 50 down, so I'm gonna buy. You buy. It goes down further, 25, and then they say, okay, can go lower. Yes, you can. You buy, right, and it goes down further, 5, 10. when it's going to be end. If the company's fundamentals are not good, okay, then it might actually go to zero or delisted. So the price is really irrelevant here. And then even if some company, great companies, like let's say the $5 share to start, let's say, and then now it's 15, right? Like already multiplied by 3. I wouldn't recommend if it goes that fast in the first year. I wouldn't recommend to buy it, even though it's a great company. It's always the initial first year is a hype. It is because of the human nature, you know. Like we're dealing with humans. Like when we trade something of the stock, we're dealing with humans. So you got to kind of incorporate that. If it goes up that high, then it's better to wait. Within a year or two, you know, some sort of like external shock, right? Not necessarily the level of like a COVID shock or a Lehman shock, but then like something happened and then it always goes down, oftentimes. That's a time you want to buy, like if you know that the company is great. But then in any case, if you even if you have too much money and then it say, hey, you know, like I'm gonna you know, invest anyways. Just wait, like okay, it might goes down and then you can actually buy more if you are keep earning, right? But that's a smart move. But then after 3 or 4 years later, it'll exceed that 3 easily. Generally speaking, if it's a great company. And then you invested in small, you know, when things are low, because you know the company intimately. That's really the game of the things. And how about like also I want to just a little bit segue into like how are you gonna capital allocate your money. The important thing is it's always a comparison, okay? So let's say if you have a $2, right? And then you will imagine this $2, which company or what activity I use this $2 gives you the most benefit. That's the one you want to put in. So let's say if you have like a stock market going up, but then you kind of suspect this is kind of getting too high. You don't want to invest that too, even though this is an excellent company. Just imagine this $2, what you can do. Like, right, like you can travel. You can buy, you know, some sort of like equipment for your business. Do something with it, right? And then you imagine what this $2 gonna by doing it, how much of the experience or benefit you can gain. So you're basically maximizing this value of the $2. And the same thing, like, I would not really suggest just putting in one basket. Okay, some people actually claim that one is okay. But this is a very difficult thing. Like if you put a whole egg in one basket and then say, okay, go along with the company, like let's say Amazon, right? Like if you were one of the guy who invested, like it might jump like 1,000 times. Like if you have like $10,000 invested, what, $10 million in 20-25 years. But that really happens. And I'm not sure that's even actually good strategy, just because like you're gonna have a lot of like anxiety here, like when you going up. It's you know, at the end of the day, you want to live not a maximum amount of money possible, but then you want to have a peaceful, in a sense, worry-free life. Then I would recommend, like, you know, when the one stock that you've been watching is going too high. Now figure out another stock that you might know that this is good, but that you might have missed. and then see if that $2, like just imagine, okay, a year, this one might go down, or if I go up, probably just going to be a little bit more. Then buy the other one, because if you just kind of imagine that, a year later it might goes like, one goes like 20% and the other one goes like 10%, you want to put in that 20% one, so you buy the different company. And do like this, but then don't over diversify, because over diversification kills your increase. And you can actually do the calculation, and then it'll kills. The more you spread apart, there's optimal number. It depends on how much you have. I would say 10 is good for most of people. Okay, more than that, you might be getting the more what's it called, over diversify. You can be more aggressive as you get more experienced, to possibly 2 or 3 or 4. But I would say 2 is still quite almost too aggressive. Now, how are you going to value more mathematically if you're inclined to evaluate the company? So this is actually very useful, but then it's difficult. So I need you to really investigate yourself if you want. Like so this is a Warren Buffett's method. Actually, it requires a lot of like your educated guess. So this is still a guess. Okay? Nobody can really predict what's going to happen in a few years ahead. But then that's what we have to see. We're invested for the future. It's not investing right now, the company now, but for the future. So it's a free cash flow, and then you discount it with the coupon that's connected to the general treasury value, or as if it's a bond. Yeah, it's a little bit mathematically complicated, but then you can actually type in ChatGPT to do it for you, or things of nature. But the assumption that you make may differ, like each shares, but then it can be quite accurate if you are if you know that company is financed enough. But then you have to actually know how to read the accounting and so on. But then now with the AI, you can just dump in the like a 10K or 10Q, and then have AI figure it out. But the assumption part, like how much growth that this company will make per year, every year, given that the past performance, those things are the way you assume really makes a huge difference. For instance, some companies, like if the growth is like, let's say you assume like 10%, and then the other one is 20%. In 5-10 years span, it's just the price differential is like one is twice or 3 times more. Okay, so there is a lot of like if there, but then if you're inclined, I would recommend you to use that method. Yeah. Yeah, it's a Buffett's method. So you should be able to find it like real easy. But then if you don't know anything about it, then that's completely fine. Just as I said, it's all about long term. Never speculate, and good things will happen after If you do it right, good things will happen within 5 years. You will see something, some movement. Not a spectacular thing. Spectacular things, you might have to wait 10 years. But then you will see, what you did right, what you did wrong. And then if you know that the company is not doing right or something's going completely off, for instance, the company could not adapt to the new technology, like human gets chef, then just get out. Always just, as I said, capital allocation is just a comparison. If you have that money, if you know the choice B is better, move to the choice B. You are staying in the choice B or choice A, right? Like this particular company for that long, because that company is better than anything else. That's the company you want to invest in. You want to invest in a company which is the number one, not a number two. Number one. Why you invest in number two? Makes no sense. Your money is well spent on the number one, right? Because it's all about the comparison. So, yeah, the more you are expert at certain domain, the more you understand the company better. So, find your own way and invest. Capital allocate your money wisely. Thank you for watching. Please share your ideas in the comment section below to help each other, and hit like and the subscribe buttons so you get notified of the next video. See you next time.